Hello and welcome to the Wealth Accelerator series. My name is Todd Dolshall with Elevator Retirement Solutions. Excited to share with you an action-packed recap of our session that we did on March 4th, discussing geopolitics and how that impacts the U.S. financial markets and how to navigate this in this ever-changing world that we find ourselves in. I hope you find this session really enjoying. Please share your feedback with me via email or otherwise. And without further ado, we will go ahead and get started. So like I mentioned, of course, really been doing this for a long time. Been doing financial advising, wealth management, planning for over 18 years now, and founded my firm, Elevator Retirement Solutions, my practice affiliate with LPL. And today we're going to be discussing how geopolitical events can influence and impact investor performance, investment performance, and some different things from a historical perspective that will be helpful for us to look through. And any questions, thoughts, feedback, please reach out to me via phone, email, otherwise, and we'll go ahead and get going. Okay. So in terms of the relationship between global events and the markets, when we're talking about stocks, bonds, real estate, so on and so forth, global events would, just to define that, would include conflicts, elections, policy changes, and anything that creates short-term uncertainty. And when there's uncertainty, that creates volatility, which is where the markets are moving up and down. And all things being equal, the market does not like uncertainty. So when there's uncertainty, oftentimes they assume the worst. And that is what triggers short-term sell-offs when there's uncertainty. The opposite can be true as well, right? When we talked about the dot-com bubble in the previous session with irrational exuberance, as the Fed chair at that time said, where prices were just beyond anything that we had seen before. So it goes back and forth between the really high highs of the fear of missing out and excitement, and then the low lows of panic, which oftentimes causes us to buy when things are really high because we're really excited, and then conversely to sell and panic when we're stressed, especially when it comes to geopolitical events that we may be passionate about emotionally. However, with this from a historical perspective, oftentimes these are really temporary short-term events that don't really impact the market for very long. And we're going to get into some specifics. But in terms of key drivers that oftentimes do impact the markets, both in a short-term and long-term direction in a meaningful way, number one is U.S. corporate earnings, right? If companies are making more money, all things being equal, that typically will drive up the value of their stock price because we're investing for current and future earnings potential. Domestic economic fundamentals, so consumer price index, when we're talking about how people feel about the economy, debts, etc., all that does impact the markets in a very consequential way. Consumer spending patterns, right? We live in a consumer-based economy. In fact, the biggest in the world by far. So the consumer leads the economy, and where consumers spend money, there's businesses to fill those needs, turn and make a profit, and then from there, us as shareholders who invest in those companies, whether that's investing in individual stocks, ETFs, mutual funds, etc., all those come with the pros and cons. But when we invest in them, we're actually a partial owner in those organizations, and we're trying to buy into companies that have a higher consumer spending projected in the future. Next is employment data. Of course, that's why we hear on the news a lot about the labor market and the jobs market. How many companies are hiring now? How many people are not hiring? So on and so forth. And while there's certainly challenges with the BLS right now for various reasons, including just survey fatigue and businesses not filling out surveys from the BLS as often as they used to, it's an imperfect system and very patchwork amongst other things. So when it comes to the employment data, if people aren't working, all things being equal, and there's less people in the workforce, that's less that they can consume and invest, etc., all of which could have negative implications in the markets, whereas the opposite, of course, is true too. Last but not least here is what the Fed does with interest rates. So the higher the interest rates, that's a means of cooling inflation, which essentially slows down the velocity at which we can borrow and move money around, all things being equal, whether we're talking about buying a business, buying a home. There's a million and one things that can be out there. But in a low interest rate environment, that really does incentivize us as individuals, businesses, governments, et cetera, to borrow with the idea that we can make more money than the interest rate that we're paying. So the Federal Reserve very much does drive the market, and that's why you hear about it a lot in the news. So all this comes with risks, of course, but again, to recap, key drivers of the market can be U.S. corporate earnings and the growth, domestic economic fundamentals, consumer spending, employment data, and interest rates. So to put this in perspective, took a look at the last 25 years of stock market performance and found a study that showed that 28 negative geopolitical events cause downturns in the market. And it's pretty interesting. Of those negative 28 events, we found that only 16 of those had significant stock market declines, and the average decline was only 1.5%. So when I say significant, when we're talking about seeing your portfolio going down potentially thousands or hundreds of thousands of dollars or more based upon the account size, that can feel like a lot when you see that, when you check your website, you get your statements, etc. But from a percentage standpoint, the declines are overstated oftentimes by the news and the media, especially when we're talking about an index like the Dow Jones, which thousands of points down sounds a lot worse than just 1.5%, for instance. And of those declines, only 5 times did we see a situation where those geopolitical events caused the markets to be lower a month later. Or said differently, at last 25 years, based upon the data and research that we have, only 5 of those events caused the stock market to be lower just 1 month after the fact. So all things being equal, geopolitical events, while they might be horrible atrocities that are going on, may not agree with policy changes, so on and so forth, it oftentimes triggers emotional reactions, whether that's excitement, or conversely, the amygdala hijack, which is fear, from a fear-based perspective, wanting to sell to make the pain go away. Best thing that we can do in that situation, take a look at your plan, talk to your financial advisor, somebody like me, do it on your own, look at the math, look at the data, and slow down so you can make decisions from your prefrontal cortex based upon the rational mind. And when in doubt, best thing you can do is sleep on it, because if you feel the same way the next day, then that's something to ask a question about, where oftentimes that will fade away over time. And so behavioral finance and psychology really are tied together. And in past Wealth Accelerator series, we've talked a lot about different research studies that show that with Dalbar and others. So in terms of geopolitical events, I couldn't think of a bigger geopolitical event in my lifetime than September 11th, 2001. Of course, many of us can remember exactly where we were on September 11th when the World Trade Center events happened, and just the horrible atrocities that ensued that day and afterwards. Now, backing up, however, in terms of the stock market and investing, right, just to put that in perspective, while the markets went down, of course, after September 11th, those markets actually recovered within 30 days from their pre-September 11th market levels. So said differently, if you did nothing from September 11th through October 11th, your portfolio more than likely recovered. So that's why when it comes to geopolitical events, regardless of whether they're massive international and domestic events like that was, or other things that might be smaller, and of course, that's only something that you can decide for yourself. All things being equal, don't let geopolitical events dictate how you invest and how you plan for your financial future. Go back to your plan, come up with a strategy, look at the data, because whenever there's changes, there's winners and there's losers, or perceived winners or losers. And that's where we can take advantage of those extreme reactions to the marketplace, either up, down, or sideways. Okay, so in terms of the latest trend that we've been hearing a lot about in the markets is the Sell America trade. So it kind of feels like an episode or a reality show. That's kind of what it feels like geopolitically lately as I'm recording this in 2026. So essentially what happened is back in April of 2025, so a year ago almost at this point, we introduced, and our government introduced via the president, the taxes that are known as trade tariffs. So trade tariffs are essentially import taxes that U.S. businesses and consumers pay, not other organizations, not other nations, right? That's what it is. It's a tax, and this causes prices to go up with the idea that if we're going to penalize businesses and consumers by importing from other parts of the world, then they're going to have to pay a premium versus if they just bought U.S. domestic produced materials, services, so on and so forth. So kind of interesting approach there. You can debate later whether that's correct or not, right? That's not the scope of this. But that did cause a lot of concerns around the world, and it really weakened our relationship with NATO and other countries that we have massive trade relations because the world is very interconnected. And like it or not, the fact is we have more in common than we don't. And with the economy and the international economy as interconnected as it is, when one country such as ours goes rogue essentially and starts imposing these things back and forth, that causes uncertainty. When there's uncertainty, there's negativity. And then when negativity happens, that causes the markets to go down, reduces the flow of capital, and then away we go, so to speak. So the initial reaction was not good, right, to this. The S&P 500 and the NASDAQ, which are both indexes and composites of large cap stocks, declined more than 2%. Treasury yield spiked, which means that investors were dumping US bonds, which caused those interest rates to go up and bond values to go down. So it's that teeter-totter effect. And we saw, as a result, the value of the dollar drop its biggest amount since April. So just a really interesting time that we're in right now. And we saw this again last month in January here. And of course, with this, we're all very much connected. And whenever we have geopolitical events like this, it's important that we keep our eye on the prize, which is what we're going to be using this money for. And interestingly enough, that did cause another ripple here in the Japanese bond market selling due to additional U.S. Pressure coming on U.S. Treasuries being sold off there. Because bond markets do impact other bond markets, right? Where investors look for the best deal they can. So if interest rates start spiking in the US because people are doing the sell America trade, that's going to cause more people to put more money into our bonds because that's going to make interest rates a lot more attractive. And then that's going to negatively impact other governments that are paying at lower interest rates. That ultimately does have a big ripple effect. And then the market recovery, the good news is shortly thereafter, we did see the political tone moderate more long term. And then as a result of that more measured approach, we did see the market come back in a nice way, and that reduced volatility, at least geopolitically. So interestingly enough, despite what you may hear or feel from the news or otherwise, the US still does remain to be the dominant standard. I was going to say the gold standard, right, which that's a whole section in of itself and something that we're going to get into commodities and other things like that. But the truth is, we didn't see a huge sell-off that lasts very long. So despite those concerns, the debt levels really haven't changed all that much, right? We still have over 33% or a third of our U.S. Treasuries are owned by foreign entities, and 18% of our U.S. stocks are owned by foreign investors. So we very much live in a world where essentially we're all interconnected. So even though we have a trade deficit, right, where we buy goods from the rest of the world, they're investing in our stock market, investing in making our economy better than it otherwise would. So it's a very symbiotic relationship where we all need each other, right? So think about it this way: if we can borrow at 5% and then take that money, consume, and invest in our stock market, and get pretty nice returns significantly higher than that, that creates an internal arbitrage situation, which is why the United States economy is the largest economy in the world by far. So with that, a lot that I can get into, and I was getting ready to get in the weeds with my international economics background, but for now, we'll leave that there. Okay. So what can we do? So key investment success to focus on is really just focusing on what matters, right? Asset allocation is a fancy way of saying diversification, right? So ultimately, what we're trying to do when we're picking individual stocks, ETFs, is we're trying to get growth in our investments so that we don't have to work forever, or we can make a larger donation to charities. We can give more money to our families, right? We can consume more, we can travel more. All those things tie back into the economy, right? In a good, healthy way. So what we're trying to do there is diversify and think about things that don't all go in the same direction, whether it's a self in tech stocks, real estate, cash bonds, commodities, etc., by having a broad, diversified portfolio that you know those investments well, you've got good price per earnings multiples, so on and so forth. That's a great time to look at that and really evaluate to make sure that you understand what you own, when you're going to get out, and what that exit strategy is, right? So the key is to have a strategy, patience, and flexibility, and know that there are going to be times, if you haven't experienced those already, where you're going to want to abandon the plan, especially when the market's down significantly. But again, that perspective we talked about, less than 6 times in the last 25 years, we've seen the market stay down for more than 30 days after the original geopolitical event. So time is key, patience is everything, and that's where I'll work with you on figuring out where we need to be on the efficient frontier from a risk versus return basis. Now, with that, I want to say thank you so much for listening to today's recording of our session that we hosted live on March 4th. If you have any questions or other comments or topics that you want me to cover next quarter's event, please let me know. My real passion is for education and teaching investors, whether I'm working with them or not, how to ultimately move their plan and their life forward by understanding how to invest, put together a plan, and coordinate all the resources together through various means. So appreciate your time. Thank you so much for attending, and I hope you have a wonderful day. Take care.